The CPI data is not what it seems. We're not out of the woods. Not quite yet. Well, most of the headlines gave us a very optimistic report. The CPI inflation cools to 3.3%. Inflation slowed in May, hinting at welcome relief for consumers. May CPI report comes in soft. Inflation surprise, prices unchanged in May, defying expectations. U.S. inflation broadly cools, an encouraging sign for Fed officials. So, what's the big deal all about? On a month over month basis, the Consumer Price Index, the widest measure of inflation, up 0.0%, flat. Inflation did not rise on a monthly basis. This is a pretty good sign, especially considering the past couple months we were at 0.4, 0.3%. On a year over year basis, the consumer price index was up only 3.3%, following last month's 3.4 and the month prior 3.5. So this looks good. Core CPI, this excludes food and energy, the more volatile components of the measure. That was up 0.2% on a month over month basis. That looks good. On a year over year basis, core CPI up 3.4%, the lowest low we've seen in a very long time now. So let's take a look at the CPI. There are different components that we measure consumer prices. The weakest components by far are energy. Energy CPI down 2.0% on a month over month basis. That's a big drop for a monthly change. Gasoline down 3.6%. This is what we really attribute the weakness in the consumer price index report today. Energy and specifically gasoline. And we have something else to tell you about gasoline in just a moment. Here's on a month over month basis, CPI energy down 2%. First negative in several months now. On a year over year basis, however, doesn't look so weak. CPI energy up 3.5%. See, here's the rub. On a month over month basis, that shows us the immediate trend. But one change in the market does not indicate a trend. The trend in CPI energy is still very much to the upside. What about gasoline? On a month over month basis, down 3.6%. That looks really good. First negative number in about 4 months. But on a year over year basis, we're telling a different story. Up 2.2% compared to this time last year. And in fact, this is the first positive reading in about a year or so. So, on a month over month basis, the weakest part of our CPI data is actually still trending higher. It's just this month it blipped lower. Why is CPI energy declining, at least on a month over month basis? Well, it's very easy to see. Here's crude oil futures. Crude oil has sold off quite a bit from highs near $87 just a couple months ago down to lows near $72. It's down about $10 on the commodity in the past couple months or so. So as crude oil goes down, logically, energy and specifically gasoline prices go down. Why are energy prices on the decline at all? Well, we have here the Energy Department announced it will sell 1 million barrels of gasoline from its strategic petroleum reserve to lower gasoline prices during the summer travel season. Now, we avoid any political discussion here. We only talk about the data. However, there is the conspiracy theory that gasoline prices, we want to see them lower coming into an election cycle. But we'll leave that up to you to discuss. There is still quite a bit of inflation, though. On a year over year basis, we can see several strong components, and that includes CPI shelter. Notice if you can detect a similarity between these. Rent of primary residence, owner's equivalent rent of primary residence, CPI housing. If you guessed housing, you are correct. The strongest segments of the consumer price index are the housing numbers, either rent or overall shelter prices. And unfortunately, we've seen that these numbers tend to be a lot more sticky. Rent doesn't come down so fast, not as fast as gasoline prices. Taking a look, for example, on a year over year basis, this is Consumer Price Index. This measures specifically the owner's equivalent of rent of primary residence, as if we were going to rent something, a new apartment or house today. Well, that's up 5.6%. It is declining. Now, this truly is a good sign that this is declining, but it's up 5.6% over this past year. Certainly, it still has a lot of room to go. What is the bond market telling us? The bond market usually gives us the best insight into the truth in the markets. Well, on a daily basis, we see the blue bars, we see a specific change, and that is down. Down on the blue bars, that's the daily, that's how the market basically reacted today. The 5-year bond down 0.1%, 10-year bond almost down 1.1%. So we've seen a sell off specifically, not so much on the 1 year or the 2 year, but on the medium term maturities. The reason why that's important is because the medium term maturities tell us a market's expectation for future economic growth. Short term yields like the 1 year, that's more reflective of what the Federal Reserve may do. And the Federal Reserve, it's thought they're going to cut rates, but not immediately. We're going to show you exactly when. Uh, Blue line over here, that's the 1 year US Treasury. Red line, that's the 10-year US Treasury. The gray bars in the background, that represents the spread between the 1 year and the 10-year. And of course, we still have very much an inverted bond curve where the 1 year Treasury pays more than the 10-year. Now, in particular, notice the pattern, what's happening, and this is very telling. It's very indicative of what's happening in the markets. The blue line is not going down. That's the 1 year Treasury. The 1 year Treasury, again, is most reflective of the future Federal Reserve decisions. Are they going to cut rates? Well, the 1 year Treasury says not yet. The red line, the 10-year US bond, that is more reflective of long-term economic expectations. Will the Federal Reserve have to cut rates more drastically over the long term? Are economic conditions slowing? Well, that's what the 10-year bond is telling us. And we're seeing a widening here. Last week, we spoke about the 10-1 spread. It was around 72 basis points. We're now at 80 basis points. The 1 year Treasury bond is 80 basis points, almost a full percentage point higher than the 10-year. When will the Fed cut rates? That really is the $1,000 question. Well, here are the probabilities from the Fed funds futures, and this is in particular for the September meeting. And notice what we see here. There's now a 75% chance the Federal Reserve will cut rates in September, not in July, but in September. That is still considered to be the pivot point, but notice what's happening. The odds are very much improving. We only had a 50% chance that the Federal Reserve would cut rates in September prior to the CPI number. So whether we, believe that the CPI number really is coming down, or maybe it's being masked by weak energy prices, the Fed funds futures are pricing in a 75% chance the Fed will cut rates in September. Well, we ran a poll just the other day. We wanted to throw this poll out before the Fed meeting today, which, by the way, we're going to talk about later this week, as well as today's CPI number. And for those of you that voted, thank you very much. 40% of the vote forecasts the Federal Reserve will not cut rates until December or maybe even later. September is only a 23% chance. And again, the Fed funds futures indicate a 75% chance that the Federal Reserve is going to cut rates in September. But our viewers say only 23%. Do you have an opinion why this may be? What's the disparity? Are the Fed funds futures right? Did they get it wrong? Well, we wanted to see a reaction after, and we put up the same poll again. So please join us in our community tab and vote. Based on today's CPI data, when do you think now the Fed should cut rates? July, September, November, or December or later? Now, the market's telling us mixed messages, not only the CPI data, but also the jobs data. We spoke about this last week. The non-farm payrolls were up, but the unemployment rate was also up. What's going on? It doesn't make sense. Well, we took a deep dive into the ramifications of why the non-farm payroll number and the unemployment rate both went up during this last report. And I think that you'll find the conclusions that we came to are actually quite interesting.